Hello everyone, I am Anshit Gupta. Welcome back to my YouTube channel Trade Titans. Financial risk is like a storm cloud on your business horizon. It's the possibility of losing money. Every business faces risks. Ignoring them is like setting sail in a hurricane. Financial risk management is your umbrella. It's how you identify, analyze, and deal with these threats. There are many types of financial risks. We'll look at 4 market risk, credit risk, operational risk, and liquidity risk. Each one can impact your business in different ways. Understanding them is the first step to protecting yourself. Think of financial risk management as a journey. You're constantly assessing the weather, adjusting your sails, and navigating around storms. It's not about eliminating risk entirely. That's impossible. It's about managing it wisely. By taking a proactive approach to financial risk management, you can weather the storms and come out stronger on the other side. Remember, knowledge is power. The more you understand about financial risk, the better equipped you'll be to protect your business. Market risk is like the stock market, unpredictable and volatile. It's the risk of losing money due to factors beyond your control. Think interest rate hikes, currency fluctuations, or even a sudden recession. Let's say you're a small business importing goods from another country. A sudden change in exchange rates could mean paying more for your inventory. This unexpected expense eats into your profits. That's market risk in action. How do you manage such unpredictable forces? Diversification is key. Don't put all your eggs in one basket. Explore different markets and revenue streams. Hedging is another strategy. Think of it as insurance for your investments. You're paying a premium to offset potential losses. Remember, market risk is always present, but by understanding its nature and utilizing proper risk management tools, you can ride out the waves and keep your business afloat. Credit risk is the risk of losing money because someone doesn't pay their debts. It's a common concern for businesses that extend credit to customers. If a client fails to pay for goods or services, it directly impacts your cash flow. Imagine you run a furniture store offering payment plans. A customer defaults on their loan. You're out the cost of the furniture and the potential income. That's credit risk hitting your bottom line. Mitigating credit risk involves careful screening of customers. Check credit histories, verify employment, and establish clear payment terms. You can also offer discounts for early payments or require larger down payments for higher-risk customers. Credit risk is a fact of business. But by implementing sound credit policies and procedures, you can minimize the chances of getting burned and ensure a healthier financial future. Section 4. When operations go wrong. Operational risk is the risk of loss due to internal failures or external events. This can be anything from inadequate processes and human error to natural disasters and cyber attacks. It's about the things that can go wrong in your day-to-day operations. Think of a data breach compromising sensitive customer information. The financial fallout from lawsuits, regulatory fines, and reputational damage can be immense. That's operational risk in its most damaging form. You can't prevent every mishap, but you can minimize their impact. Implement strong internal controls, invest in employee training, and have contingency plans in place. Regularly review and update your security measures to stay ahead of potential threats. Operational risk is a constant, but by creating a culture of risk awareness and preparedness, you can strengthen your defenses and safeguard your business against the unexpected. Section 5. The liquidity squeeze. Liquidity risk is the risk of not being able to meet your short-term financial obligations. It's about having access to cash when you need it. If you can't pay your bills or cover unexpected expenses, it can cripple your business. Imagine you're a retailer relying on holiday sales. A sudden economic downturn drastically reduces consumer spending. You're left with overflowing inventory and mounting bills. That's a liquidity crunch. Managing liquidity risk involves maintaining a healthy cash flow. Have a cash reserve and diversify your funding sources. By monitoring your cash flow and having strategies in place, you can avoid a liquidity squeeze. Section 6. Navigating the risk landscape. Financial risk management is not a one-time task, but an ongoing process. It's about being aware of the potential pitfalls, assessing your vulnerabilities, and taking proactive steps to mitigate your exposure. Remember, what works for one business may not work for another. Regularly review and update your risk management plan. The business environment is constantly changing, and your strategies need to adapt. Don't be afraid to seek professional advice. A financial advisor can help you identify potential risks and develop a tailored plan. Most importantly, remember that while risk is inherent in business, so is reward. By understanding and managing financial risk effectively, you can minimize potential losses and free yourself to focus on what matters most: growing your business and achieving your financial goals. Remember, a smooth sea never made a skilled sailor.